Hey guys, it's Sasha. Today I am going to share my analysis of Twilio stock, and this is a really interesting one. Twilio stock looks like a really bad company to invest in, and yet I have done exactly that, gone and invested in them. In this video, I will share why that is and how difficult it is to value a company like Twilio, because like many grey stocks, Twilio is losing money hand over fist. Many conservative investors, many more traditional investors will not touch a company like Twilio with a barge pole, and there are very good reasons why. It is almost impossible to build a robust valuation model for Twilio, and this is because the model is naturally extremely sensitive to small changes in some of the assumptions that are very hard to accurately forecast. You're just picking numbers out of thin air, and I will show you this in full detail in a minute. I actually opened a very small position in Twilio earlier this year, so remember that as a shareholder, I may be biased, and also remember that I am not your financial advisor. I am just a random guy on YouTube sharing a load of numbers that I made up, so please take it for what it is. A few months ago, I shared that I bought Twilio with my channel members and Patreons in the Discord, but summer got in the way, so it took me a few months to go and make this video about it. If you want to join our Discord to talk all things stocks, investing, personal finance, a lot more, the link to my Patreon is in the description, or you can also join through YouTube memberships. Now, for those who don't know what Twilio is, which I'm guessing is the vast majority of you watching this video, Twilio is a company that provides the tools for companies to communicate with their customers. They offer APIs and various tech solutions for sending customers SMS messages, emails, phone calls, receiving phone calls, video calls, whatever it is that you want, any way for companies to communicate and exchange information with people buying their services or products. That is the business that I have actually been a customer of for several years as well. The company has been growing very fast, but the company is still losing a phenomenal amount of money, and the rate of growth has recently slowed down, so that is also a pretty important consideration. In fact, if you look at Twilio using typical conservative approaches, you would run an absolute mile. You can quickly check how bad the past performances look on Simply Wall Street, who are the sponsors of today's video. The company is losing more and more money. That's pretty bad, and it's really not getting any better. Because Twilio loses money, there is no return on equity, no return on assets, no return on capital. What Twilio does have, though, is a pretty epic balance sheet. And I do like me a company with a good balance sheet. $4.4 billion worth in cash and short-term investments, and less than $1 billion in total debt. I will put a link to this page in the description if you want to go and look at the numbers in a bit more detail. It's completely free. That link will also get you 2 weeks of free access to the Simply Wall Street Unlimited account. And if you like the platform enough to pay for one of the paid memberships, then you can get a fat discount on top. So if you want to analyze companies quickly using this very graphical interface, feel free to check Simply Wall Street out. Now, looking at the balance sheet, Twilio is doing just fine. It is great. You can see there's $799 million worth of cash and $3.6 billion in short-term marketable securities. Twilio only has $795 million of current liabilities and $987 million of long-term debt. So the company could go and clear all of their entire long-term debt pile and then have more than 4 times as much cash as their total liabilities for the next 12 months. And that's really good. The problems start when you begin looking at the P&L. Revenue has gone up from $668.9 million in Q2 last year to $943.3 million this year. And that is a pretty sizable jump and looks great, but it's hard to tell if that's good or not, because all the costs have jumped up as well, and you don't know the history. You can see that in the PowerPoint slides, they have the quarterly revenue going up and up and up, and it is up 41% this year, year on year. But you can also see that the rate of growth is decreasing, and it fell pretty sharply in Q2. Now, I went and looked through their financials for the last 7 years and put all of the data into my Excel spreadsheet, and you can see that the revenue growth for Twilio has been growing pretty strongly. 66% in 2016, 44% in 2017, then back up to 63% in 2018, 75% in 2019, and so on and so on. The problem is, growing becomes much harder as you get bigger, and Twilio has been getting much bigger very quickly. You can't grow at 65 or 70% a year every year forever. And the other problem is that some of this growth was not organic. In the last few years, Twilio has been busy buying up companies that make products that slot into their ecosystem. So going back to the model, I also pasted the gross profit numbers in here and the cost in here, and you can see the numbers in the table, but look at this. The total revenue in 2015 was $167 million. And in 2021, it was $2.8 billion. And in the last quarter, the revenue was $943 million. So Twilio earns more revenue in 1 week today than they did in the whole of 2015. But look at the costs. I made a little chart. The gray line is general, orange is sales and marketing, and blue is R&D. These are the costs as a percentage of revenue across the last few years. And you can see that while revenue has exploded, costs have exploded just as fast because costs as a proportion of revenue are pretty much flat. Although the company now makes over $1 billion a quarter, economies of scale have done absolutely nothing so far, and the costs are actually higher today as a proportion of revenue than they were back in 2015. And ultimately, this is where one of the big problems for Twilio sits with trying to forecast future performance as an investor. There are 3 numbers that are pretty crucial to the final outcome in this valuation model: the growth in revenue, the gross margin, and the rate at which costs reduce. Because if costs don't reduce, Twilio will never make a profit, and you probably should not be investing in a company that will forever lose money, right? So you'll only invest assuming that the costs will drop. The question is, how fast will they drop? In the last 2 quarters, the rate of growth for Twilio has slowed down to 48% and 41%. And Twilio forecasted that the rate of growth will slow down a lot more, down to 30 to 32% range year on year in Q3. So that's another massive drop. And this forecast was made at the beginning of August, so they already had a month of data on which they could base it on. Although Twilio do have a bit of a history of undercooking their forecasts. Now, I went and stuck an average of 37% growth into the model for this year, which is roughly where it is likely maybe to come out if you go and draw those, the 2 quarters we already have data for, the forecast and whatever happens in Q4, and then have that rate declining from there year on year as Twilio grows even more. Then I kept things very simple, and based on the numbers so far, I just assumed that the gross margin sits at a flat 50% because that's how much it costs to deliver the service. Now, you could argue that, size and better technology and blah, blah, blah will drive some of those costs down, but there are bigger fish to fry in the other assumptions that I might just keep this one constant, especially given how sensitive some of these other assumptions are, and given that we've not really seen on the gross margin any real movements to date. Next, I took each of the cost lines and started reducing them a little bit year on year. So both the revenues are going up and the costs are going up, but the costs are going up a little bit more slowly. So R&D, for example, goes from 28% relative to their revenues at the moment, down to 19% in 2030. Sales and marketing goes from 35% of revenue right now to 23%. General costs go from 16% down to 13%. And if you think that these numbers are about right, for example, and go and look at what the model spits out, using a 4% long-term growth rate and an 18 times EBITDA multiple in 2030, I get a target share price of $53 using the perpetuity approach and $50 using the EBITDA multiple approach. And Twilio's share price is $75 as I'm recording this video. So if that's the model that you've built, for example, you'll be saying a big fat no thank you. Twilio is massively overvalued by almost 50%. But go back to the assumptions and make a few tweaks. Let's say that revenue doesn't quite drop so fast. So I have 37% growth for this year, but let's say that they beat their Q3 target and Q4 isn't all that bad. And then let's say instead of being 37% this year, it is 42%. A perfectly reasonable estimate that could easily happen. And then let's say that next year the rate of growth doesn't fall all the way down to 36% because it's been way, way higher every year for the last 7 years, and there's evidence that potentially it might continue growing for a bit. Let's say the rate of growth only drops by 10%, for example, and then drops by 7% every year after that. A pretty small tweak, but then let's go back and look at the output, and way, we have a target price of $77 to $83 now. So we've already jumped to above where the current share price is. But then let's go and look at the costs. I forecast that costs will increase as revenue increases, but every year the rate of growth will decrease by 5% as a proportion of revenue. So let's say costs grow 10% less every year instead. So for example, R&D goes from 28% this year to only 12% of the total revenue in 2030. And look, in 2030, the revenue is 8 times higher. So although R&D has dropped in percentage terms, it is still at $3.9 billion in 2030 compared to $1.1 billion this year. And by the way, $3.9 billion is 50% more than what Tesla spent on their R&D last year. So it's a pretty big number. Reducing costs faster isn't a completely ridiculous and absurd assumption. It could well happen. And then let's go and make the same assumption for the other costs. And what happens with the outcome? You reduce the costs faster and boom, the target price goes to $320. Did you see how sensitive that was? Let's go and change that drop from 10% to 11%. Boom! The target price is now $360. Reducing the costs faster by 1% per year increases that target price by over 10%, and that's an extra 50% upside relative to the current share price in terms of your valuation. In fact, the rate at which Twilio can reduce its costs is more important in the valuation in this model than the rate at which the revenue grows. Although, of course, revenue growing also does help with reducing the cost as a proportion of revenue. So let's undo all of that. Let's go back to the original assumptions. Revenue growth drops by 15% in the first year, then 10% after that. Costs grow by 5% less each year. What happens if the costs, say, only grow by 3% less each year? Well, let's put it in, and the revenue continues growing at exactly the same rate. Everything else is exactly the same. The costs grow slightly less fast than revenue, but not fast enough, and that makes Twilio unprofitable in 2030, and the target share price comes out negative. So this is obviously quite a big problem. Data over the past 7 years gives us absolutely no indication, no information whatsoever on how quickly those costs will reduce in the future as a proportion of revenue, because they haven't been reducing at all. They've been increasing, even as Twilio has been growing. And when you make a random guesstimate, which is what you're doing in this kind of model, very slight changes in the percentages of early stage companies can go and make wild differences to what you think a fair share price is. My personal assumptions give me enough of an upside that I have made an initial small position in Twilio, but the risk profile here is really high. So for the time being, that position will remain small. If you haven't done it already, remember to go and check out Simply Wall Street through the link in the description. It's free and you get some pretty cool data from it. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm, and thank you so much for watching. I really appreciate it. I'll see you guys later.